Welcome to the Valuation Master Class Show. This is Andrew Stotz, and I am going to talk about something quite fun. In fact, I've been just fiddling with numbers for the last couple of hours to prepare for this. The thing that I'm going to be talking about is the concept of how to calculate the value a company creates. In other words, does a company create value? If a company doesn't create value, then it's destroying value. You want to invest in a company that's destroying value? No. One of the questions that you have to ask is, if a company is not creating value, does that mean that it's having a negative return? In other words, would a company have a positive return on invested capital if it was destroying value? That's a good question. Another question that you may want to think about is, do we create value by reducing the cost of borrowing? Or do we create value by making our assets more productive? Another question you could ask is, what is the valuation of a company that's creating value versus destroying value? Now, that one we can answer right now because we've been working in the Valuation Master Class bootcamp on a company called Platinum in Thailand. And the company is destroying value right now, according to our numbers. Now, the forecast, it's really going to depend on how the company can deliver on the spending that it's doing right now. And I'm going to show you, in the case of Platinum, I just want to explain that the company is destroying value, but does that mean that its return on invested capital is negative? We're going to answer that. So I'm going to walk through a series of slides that I created for this to help you visualize and make the calculation on your own. So again, this is how to calculate the value of how to calculate the value that a company creates. It's Friday, 16th of January. We're halfway through the first month of the year. And if you want to get a copy of this PowerPoint, just send me a message at Andrew Stotz, and I'll send you the PowerPoint. So let's go into the first one. The first thing is that in order to make a really robust study of this, we have to look at a lot of companies, not just one or two, because then we just get some anecdotes or some examples. So I have a data set of 10,000 companies. I've been maintaining that data set, myself and Sonsak and Alex here on the team for decades. And that data set is beautiful, it's clean, it's valuable. So we're going to start with that data set of 10,000 companies. Now, in this case, we're just going to use 2024 because we have the closed books for 24 for all companies in the world. We don't have the closed books for 2025 for almost any companies in the world. And I want to do it on an annual basis just because it makes it more simple. So let's go to the first step. The first step is sum the invested capital. Now, what's important is when you think about invested capital, you want to think about interest-bearing overdrafts and short-term loans and interest-bearing long-term debt. If a liability, which those two are, is not interest-bearing, we would say it's not invested capital. Then we have minority interest and, most importantly, the equity that has been paid up in the company from the beginning, and also the retained earnings that have been accumulated over that time. And from that, as you can see, we can get a invested capital number of $52.9 trillion. So now let's just take a step back for a moment and think about this. So let's just call it $53 trillion. We can say that investors, whether they're equity investors or lenders, but let's just call them investors, have put $53 trillion of capital at work at these 10,000 companies. So now the question is, what do those companies do with that capital? Well, what they're supposed to do is invest that capital into productive assets. What is a productive asset? Well, let's just imagine that we have a startup company today, and we start up a company and we put in $100,000 in cash. That's our first paid up capital that comes in the liability side of the balance sheet, and it's represented as 100%, 100,000 of our assets is cash. Okay, so that's our starting point. But of course, nobody's paying us to put cash at the bank, right? They're paying us the capital. They're putting in the capital, or we're putting in the capital, so that we can put it to use. And when we put it to use, the hope is that we're going to generate higher and higher returns on that capital. Well, you're never going to get a high return if all you do is take cash out of your bank, your personal bank, put it into a company, and the company puts it on deposit at the same bank. There's never any money going to be generated from that. So what business is how do we take that cash and deploy it into what we would call productive assets? Now, let's imagine that you've got this cash of 100,000 and your friend says, hey, my business is doing really well. Why don't you invest in my business? Oh, okay. So we take the 100,000 out of the bank and we transfer it to our friend's bank of his company. And we buy shares in his company. Okay. Now we took our 100,000 and we put our money into shares of another company. Now, our objective is to hold those shares for a long time. And so we have a long-term investment, we call it. So the question is that a productive asset? Are we working? We're not working, right? We just took the money and put it in shares of that company. So we would call cash and long-term investments in other companies non-productive assets. I think about my own business, my coffee factory, and the productive assets. You can just walk in the business and see it right there. The roasting machines, the grinding machines, the packaging machines, all of these things are productive assets. So now let's go back to, we said that the company now has put in, investors have put in $53 trillion. Again, this is 10,000 companies. So now let's move to the next step. The next step is subtract financial assets from invested capital. So what are the financial assets? Well, we can see cash and short-term investments and also long-term investments. If we sum those up, what we can see is that sums up to about 11.6 or so financial, in other words, non-operating assets. We're going to subtract these from invested capital, and we'll end up with invested capital excluding financial assets. Now, we can also call this operating capital, right? This is the operating capital that we've allocated into the business. This is a great number. So we've gone from 53 trillion down to, let's say, 41 trillion. Now, I want to talk about the big item here you can see is cash and short-term investments is $8.8 trillion. I want to talk about that for a moment because it's important to understand that one of the reasons why, well, the main reason really, in fact, I'm going to go back to this. Why are we subtracting cash? Well, partially because it's not productive, but there's another way to look at that. Let's look at that this way. If we look at the total interest-bearing overdrafts and long-term debt, it's 15 plus 6, let's say, so $21 trillion roughly of borrowing that these companies have done. Now, they also have 8.8, let's just say 9 of cash. So if they wanted to, they don't need 21 trillion in debt. They can actually pay that down. And therefore, what we could consider is that really you could consider that the interest-bearing overdrafts and short-term loans and the interest-bearing long-term debts, they're a gross figure. But if we were to net them out by saying reduce the amount of cash and short-term investments, then we would have what we would consider to be the net interest-bearing debt in the company. So that's the reason really, partially the reason why we're subtracting the cash and short-term investments is because, yeah, it's not operating, but just practically, if I was to take over that company as an example, I may say, I don't need the debt. I'll use a big portion of the cash to pay off the debt. So that raises another question. And this question is, what should we subtract, all cash or only non-operating cash? Well, the textbook answer to this is only non-operating cash. Let's say we have about $9 trillion in cash. Let's say that these companies only really need $1 trillion. So if we say 9 trillion minus 1 trillion, we end up with 8 trillion of non-operating. You don't need it to operate the business. So technically you could say that we would, instead of reducing the invested capital by 9, you maybe want to reduce it by 8. And that 8 is the non-operating capital that could be used to repay the debt. Now, in the textbooks, we see a number between 1 and 3 that people estimate. DeMorderin, as an example, estimates, and McKinsey also estimates between 1 and 3%. And the real way to do this is to look at the company, look at the industry, look at the company, try to understand the management style. Are they also M&A type of business where they're accumulating cash and they're holding it, they're hoarding cash, getting ready for their next big acquisition? Do they have a big expansion coming up? We don't know. So the answer to this problem that I find is, I'm going to give you my solution. My solution is I reduce invested capital by all cash, both operating and non-operating. Now, I know theoretically we should reduce by non-operating, but I just want to say that there is no consistent way that we can calculate this number by company, by country, by sector. There's no academic research that I've been able to find, and any research that I've been able to do, to accurately determine the level of non-operating versus operating cash. So then you may say, well, Andrew, why don't you just estimate? Like DeMorderin estimates between 1 and 3. So you could just say, 1 and 3%. In this case, when I say 1 and 3, I mean 1 and 3% of total assets. Right now, cash as a percent of total assets is about 11, roughly. So basically saying you would get rid of 10%. You would get rid of, let's say, 10 out of 11 in cash. So the reason that I don't do that is because if I keep it as removing only all cash, now I at least have a standard way of going across all companies. But if you decide I'm going to do operating adjustment, you have to make adjustment in every company. You're looking at a benchmark. You need to make an adjustment for that benchmark, right? Tan May, always thinking of you. I really want to catch up because so many different things are going on. So let's do a video call when we got time. It's good to see Tan May, one of our Valuation Master Class Bootcamp graduates, an exceptional man. So let's continue on now and go to the next step. So now we have subtracted all cash and all long-term investments, which we'll call them financial or non-operating assets. So now we have invested capital excluding these financial assets, and now ultimately what we have is operating capital. So now the next step, the third step in this, is to calculate the NOPAT and ROIC. Now in this case, earnings before interest and taxes, or EBIT, is 5.8 trillion, and the estimated tax rate is 24.78. And so what we then do is say 100 minus 24.78, and from that we're going to get roughly 0.75. So we're going to multiply roughly 0.75 times 5831, and we're going to get 4386. That's the net operating profit after we have adjusted down EBIT for it. And what do we end up with? Return on invested capital of about 11%. There it is. That's the calculation. This gives you the calculation. Not only am I giving the calculation, but I'm demonstrating it by using actual numbers of 10,000 companies across the world, from US to China to everywhere. And I'm giving you a calculation that I think, is pretty valuable. Now, there's one little thing I haven't done in this case, and that is I haven't averaged the denominator. Normally we'll average the denominator, but for purposes of teaching, I don't think we need to do that. So I think we've got a good explanation now of how to calculate the return on invested capital, but that doesn't answer the question. What was the question right at the beginning? Let's just go back to how to calculate the value a company creates. That was the question. So in order to think about this, what I like to think about is that when you look at a balance sheet, you want to look at the liabilities on one side and the assets on the other. So the question is, we're going to raise capital. Remember before I talked about $100,000, and we're going to deploy that capital into assets. Now, a portion of that capital, let's say, whoa, that's not easy to do. A portion of that capital is debt, and a portion of that capital is equity, and it's going to be invested in assets. So we're going to have this certain level of assets that's going to come from debt and equity. Now, the real question is, how do we calculate whether a company is creating value? Very simple. How much is the money cost, and how much do we earn on that money? We're going to get our money from the bank and from investors, let's say, and we're going to invest it in productive assets. Let's just imagine that we could get money at 4%. All the money we need, we can get at 4%. And let's imagine that we can invest that at a return on invested capital of 6%. Would you do it? Absolutely. You're going to have a gap between 4 and 6. And that is a measure of the value. Now, let's imagine that you can get money at 4% and your projects earn 2%. Would you do that? No, you wouldn't, because you're destroying value. The gap between the 4% the money costs and the 2% the money earns as return on invested capital is negative. And therefore, you are destroying value. Now, here we answer the question. Can a company have positive return and be destroying value? Yes, absolutely. Positive return in this case is 2%. The cost of capital is 4%. And therefore, it is destroying capital, but still earning a positive 2%. So that answers that question. But now let's get into the question of how do we calculate the cost of the capital that we've raised. So I'm going to go into the presentation again. And in this case, it's going to look at this, page 6. So I also did this calculation for that universe. And I said, cost of debt is about 4% right now for that universe. The tax rate for that universe is about 24.8. Therefore, the after-tax cost of debt is going to be reduced to 3, so by 25%. And now we also can see that because price to book is very high, the equity component of companies is really high. We use the market cap value of equity. So debt as a percent of total capital is 20%. So if we multiply 20% times the 3, we end up with a cost of debt component of capital of 0.6. Now, let's just estimate that the cost of equity is 10%. And trust me on that. That's not a bad estimate as a starting point. And now we know that 20% of the capital is from debt, and therefore 100 or 80 is coming from equity. And remember, this is the market value of the equity, not the book value. And that's the reason why it's so high at 80%. If we were actually to look at the value, the book value, we may be looking more at 60% equity, 40% debt. And then we can then say that the cost of equity component is 80% times 10. That gives us 8. And now if we sum up the 0.6 and the 8.0, we end up with 8.6. There it is. Let's just say 9 for a moment. The cost of capital of the average company of 10,000 companies across the whole world, I don't think you can get a better data set than this, is 9%. What do you think? Is that high? Is that low? Well, it's about normal. I think that what we're going to see is if markets fall, let's just say that markets collapse in 2026, the price to book value of businesses is going to fall in the market. And therefore, the equity is going to shift. Equity is going to be less of the total capital. And the capital will be more coming from debt. And when it's more coming from debt, that's actually going to push down the weighted average cost of capital. And so this is also a reason why a question I often get is, do you use different weighted average cost of capital? Yes, we do. And in our value model, we definitely do that. So now we have gotten to our final step here, where we now have our calculation of WACC. So now it's time to answer the question. And that is, all we have to do is say 10.9 minus 8.6, 2.3% value created. That's it. That's how we calculate it. The average company is raising money at about 8.6% using the average blend of debt and equity. And they're investing that money and earning an after-tax return of 10.9. And that means that they are creating value. And that's really all I wanted to show you today. So now we understand that gap of 2.3. If cost of debt went down, cost of equity went down, then there would be a bigger gap. But that gap is what determines, loosely, it's what determines the price to book multiple. So let's go back to the company I started off with today. I talked about a company called Platinum in Thailand. And Platinum is destroying value right now. The returns it's earning relative to the capital invested, because they have to invest a lot. They're very asset heavy. Platinum is the Platinum Fashion Mall, where they have they rented it out, and basically people rent it out, and people come from around the world to find goods and services that they can, goods, basically shoes and clothes and other things that they can bring back to countries and export from Thailand. And so this company is destroying value, but the question is, it's not about the value that was destroyed in the past. It's about the value that's going to be created in the future. So we have to estimate that and go forward. Next time I talk, I'm going to go into a little bit more detail, because I broke down the analysis that my students did, and I dug into their financial models that they did to pull out their forecasts and expectations about this one company, Platinum. And I'm going to demonstrate more to you about that in the next time that I go live. But the key thing that I want to highlight is that Platinum has a positive ROIC, but it just happens to be lower than the cost of capital. But now let's talk about the final thing I want to mention, and that is the relationship between whether a company is creating or destroying value. In their case, they're destroying value, and generally when a company is destroying value, their price to book ratio is going to be below 1. And if a company is creating value, their price to book ratio is going to be above 1. If a company is creating tremendous value, think of Microsoft. Maybe they have a return on invested capital recently of 40%, and their cost of capital is, let's say, 10. They are creating 30% in value every single year. That's the reason why people are willing to pump up the valuation on a price to book basis. You can see that they may be trading, I haven't looked at it recently, it could be 8 times price to book, or 12, could be 6. I can't remember the latest, but the point is that that's why the price to book will get cranked up, because the company is creating value. So I was just looking at the latest price to book ratio for Platinum, and besides the fact that it's a very small and somewhat illiquid company in the Thai stock market, that usually means that it's going to trade at a discount also. But the latest price to book that I just saw on the website of the Stock Exchange of Thailand is 0.4. That is a representation that the company is destroying value. Now, here's the opportunity from an investment perspective. Let's say that things changed and it started to create value. Let's say that that happened 5 years from now, 7 years from now, 3 years from now. That's the whole purpose of our financial model, to try to estimate where we think that that's going to change. And therefore, we'll have a better understanding about when the company could potentially start to create value. Which brings me to another question I've been asked in the past, which is a company who's destroying value? Will they continue destroying value, or they have to stop at some point? Eventually, they'll run out of people wanting to invest in them because they can see they're not going to get a return from it. And so eventually they'll run out. But if they're rich, or they have a lot of friends and a lot of people want to put money in, or maybe they have a good story and they're going to claim that this is going to do well, they may survive for a long time. But eventually, destroying value is destroying the share price and the opportunity. And eventually what will happen is that the money that's deployed into those assets will be deployed into other productive assets in the economy, and the people that are employed in that business will be allocated to other parts of the economy. And that's the idea of creative destruction. Well, that was a lot of stuff that we covered. And let me just go back to the beginning just to highlight where we started. We started with this idea of how to calculate the value a company creates. And now you understand that it's the difference between the return on invested capital and, return on invested capital, which is 10.9 minus 8.6, the weighted average cost of capital. And that gives us 2.3. Wow. Well, I hope that you have a wonderful Friday and a wonderful weekend. I'm going to be back. I think it's going to be on Tuesday. I'll be back. But I want to go into more detail in this company, Platinum, and try to understand exactly what's happening with their weighted average cost of capital, their return on invested capital. So for now, I'm going to sign off and say, I hope to see you in the next session. Remember, you can send an email and I'll send you this presentation.